Most retirees overpay their taxes by 6 figures, legally, unnecessarily, and completely by accident. Not because they didn't save enough, because nobody told them that retirement is the first window in their adult financial life where they can actually control what gets taxed, when, and at what rate. That window is real. Most people sleep right through it. And in this video, I'm going to show you 7 specific strategies to use it, including one that can save your heirs over $100,000 on an inheritance they're already mentally spending, and one that's silently adding $3,000 to $12,000 per year in Medicare costs to retirees who did everything else correctly. Here is the retirement advice most people receive. Max the 401k. Don't touch it, roll it over when you leave, and figure out the taxes later. That is not wrong. Exactly. It is incomplete in a way that costs you substantially. Here's the part nobody explains at the retirement party. The average retiree faces a higher effective federal tax rate in the first decade after they stop working than they did during most of their peak earning years. Not because their income went up. Because the structure of tax-deferred accounts creates an automatic income acceleration the moment required minimum distributions begin, and that acceleration stacks directly on top of Social Security in a way that reliably surprises people who saved diligently and thought they were done with the hard part. Here is what this video is. A walkthrough of 7 tax timing decisions that already exist inside the accounts and income sources you have right now. Your IRA, your 401k, Social Security, a taxable brokerage account. None of this requires more market risk. None of it requires predicting anything. It requires coordinating when income shows up on your tax return. Getting that coordination right versus ignoring it is the difference between keeping 60 cents of every retirement dollar and keeping 80 cents over 20 years. That gap is not a rounding error. It is hundreds of thousands of dollars in real spendable money. By the way, I built a free early retirement calculator because most online tools are mathematically wrong. They use oversimplified tax assumptions that completely ignore everything I'm about to walk you through. Mine uses actual BlackRock and Vanguard modeling logic to expose the weak points in your specific retirement plan. I only ask for your email to send the report, so I never store any of your financial data. Link is in the description. Now, before the strategies, you need one idea that connects all 7 of them. Imagine a dial on the wall, a thermostat. During your working years, someone else sets it. Your employer withholds at a fixed rate, the IRS determines the brackets, and you live in whatever temperature the room happens to be. No negotiation. You earn, they take their cut, you keep what remains. But retirement, for the first time in your adult financial life, hands you that dial. You can decide when income materializes, in what form it arrives, and how much of it triggers a taxable event in any given year. The problem is, almost nobody touches it. They retire, drop their documents off in mid-April, pay whatever number comes out, and repeat that for 30 years without questioning it once. Every strategy in this video is a different way to reach for the dial before someone else does it for you. In a few minutes, I'm going to show you a Medicare surcharge that most retirees walk directly into without knowing it exists, one that can cost a couple over $12,000 a year. But first, the highest leverage move a person in early retirement can make with that dial. Strategy 1, intentional Roth bracket filling. There was a rice merchant in feudal Japan. I'm referencing a real historical trading practice here who had one firm rule. He sold his rice at the current year's price, but only in the quantity needed to stay right below the threshold where the tax collector's formula changed. Not a grain more, not a grain less. He didn't predict future prices. He didn't time the harvest. He operated on the principle that locking in a known lower rate today was always better than gambling on an unknown rate tomorrow. His competitors considered this overly cautious. They were also the ones scrambling to liquidate at terrible prices during bad harvests. Roth bracket filling is that same discipline. In the years between retiring and when Social Security starts, and before required minimum distributions begin at age 73, your taxable income often falls to its lowest level since early career. No paycheck, no forced withdrawals yet, real control over what shows up on the return. During that window, You convert exactly enough from your traditional IRA to a Roth IRA to fill your current tax bracket, typically the 22% bracket, and then you stop. Not everything, not nothing. The precise amount that today's tax rate makes worth moving. Here is the concrete math. Say you're 63, recently retired, and your taxable income sits at about $30,000. The 22% bracket for a married couple extends to roughly $178,000. That is $148,000 of bracket space sitting empty. You can convert up to that amount from a traditional IRA to a Roth and pay 22 cents on every dollar permanently. Every dollar moved out at 22% is a dollar that will never be hit at 24, 32, or 37% when RMDs begin stacking on top of Social Security. Most people avoid this because paying taxes early feels psychologically wrong. Deferred sounds like avoided, but deferred taxes are not avoided taxes. They are larger taxes scheduled for a moment you no longer control. A traditional IRA worth $1 million at age 63, growing at 7% annually, reaches approximately $1.9 million by age 73. The required minimum distribution on that balance in year one is roughly $74,000. Stack Social Security income on top of that, and for the first time in your life, you are in a bracket you never planned to occupy. The dial was set while you were waiting. Executed consistently over 5 to 10 years, intentional bracket filling saves between $100,000 and $300,000 in lifetime federal taxes. Not by investing differently, solely by converting at today's rate, before tomorrow's rate gets decided for you. Now you might think that is the main event. It is not. What comes next is something the tax code is essentially giving away for free, and the number of people collecting it is genuinely embarrassing. Strategy 2. Capital gains harvesting at 0%. You think capital gains are an unavoidable cost of investing. Make money, sell, pay the tax. That model is accurate during your working years. Here's the reversal. You think the gain is the problem, but actually the timing of the gain is the opportunity. Because the federal tax code has a 0% rate on long-term capital gains for people below a specific income threshold, for single filers in 2026, that threshold is approximately $49,000 in taxable income. For married couples filing jointly, approximately $98,000. Below those lines, every long-term capital gain you realize is federally taxed at 0%. Think about who qualifies. A 64-year-old who hasn't claimed Social Security yet, draws modest living expenses from savings, and has no RMDs yet. Their taxable income might be $25,000. They can realize $50,000 or $60,000 in long-term capital gains and pay nothing in federal tax on it. That is not a deferral. A deferral means the obligation still exists, moved forward. This is a permanent erasure. The gain was assessed, taxed at 0, and is gone from the liability column permanently. The actual move. You don't sell because you need cash. You sell the appreciated position, immediately repurchase it or something substantially similar, and you've reset the cost basis to the current higher price. You own the same investment. The embedded taxable gain is now dramatically smaller. Done systematically over 4 or 5 years of early retirement, this process converts a taxable brokerage account from a compounding tax liability into a flexible, low-cost income source for the rest of your life. The people avoiding this strategy absorbed never trigger a tax event as doctrine during their working years and carried it into retirement where it actively punishes them. A 0% tax event is not a burden. Avoiding it leaves your cost basis permanently low and guarantees a larger bill when conditions are less favorable in your 70s, possibly, or in your estate. By the way, hit subscribe if you're getting value from this. YouTube's algorithm may genuinely never show you my videos again if you don't. The system buries channels that don't convert viewers quickly. Do it now, and let's keep going. In a few minutes, I'll show you a married couple's retirement that's quietly heading toward a 6-figure tax trap for the surviving spouse. But first, here's why the Social Security timing mistake is even more expensive than most people calculate. Strategy 3, delay Social Security while drawing down the IRA. For every year you delay claiming Social Security past your full retirement age, currently 67, for most people, your benefit grows by 8%. 8% per year, compounded, guaranteed, inflation adjusted, up to age 70. Delay the full 3 years and your benefit is approximately 24% higher for life. A guaranteed, inflation adjusted, 8% annual return on a government income stream that does not exist anywhere else in fixed income. And yet the majority of Americans claim Social Security before full retirement age, almost always for the same reason. The money is there, it's reliable, take it. But the math on that decision, at a realistic life expectancy of 85 or beyond for a couple, consistently shows a lifetime income penalty in the range of $150,000 to $250,000 for a household with median benefits. That is not a small number. The correct sequence: draw from the IRA to fund living expenses between retirement and age 70. Use that same window to run Roth conversions simultaneously. Delay Social Security to 70 at the maximum rate. The result? Smaller IRA at 73 because you drew it down intentionally, smaller RMDs, a larger guaranteed income floor for life, and a materially lower overall tax burden across the final 20 years. His name is Robert. He's 68, retired electrical engineer, $1.4 million sitting in a traditional IRA. He claimed Social Security at 62 because it felt like the sensible call. He left the IRA untouched. It grew. Now his Social Security payment and his early RMDs are stacking on top of each other. And this year, he received a Medicare billing document that confused him. That document is Strategy 4. Strategy 4, IRMAA management. IRMAA stands for Income-Related Monthly Adjustment Amount. What it actually is, a Medicare premium surcharge that activates when your income crosses certain dollar thresholds. Not a gradual increase. Not a smooth curve. Cliffs, $1 over the line, and you pay the elevated premium for the full calendar year. For 2026, the first IRMAA cliff for a single filer activates at approximately $106,000 in modified adjusted gross income. For married couples, approximately double that. Each threshold you cross adds roughly $1,500 to $3,000 per person per year to your Medicare costs. A couple sitting at the highest IRMAA tier pays over $12,000 more annually than an identical couple sitting right under the first line. Over 20 years of retirement, that gap exceeds $200,000 for exactly the same Medicare coverage. Robert's modified adjusted gross income landed at $111,000 this year, $5,000 above the first cliff. He pays an additional $2,800 in Medicare premiums this year. Next year, his IRA grows, his required minimum distribution increases, and he almost certainly stays above the threshold again. His advisor never modeled this forward. His accountant handles returns, not projections. The billing system generates the surcharge automatically and does not explain why. The retirees paying the highest IRMAA bills are almost never the highest earners. They are the least coordinated earners. Income arrived in the wrong amount in the wrong year without anyone checking where the cliffs were. IRMAA management means knowing exactly where your projected income lands each year and making withdrawal decisions around those thresholds with intention. That is the dial. A man who spent 30 years building a 7-figure portfolio received a Medicare surcharge because his income landed a few $1,000s above an administrative line nobody told him existed. I find that more darkly funny than enraging. Only slightly, though. Now stay with me because this next part changes everything, specifically for anyone with a spouse, adult children, or any meaningful amount of money to leave behind. Strategy 5, spousal Roth conversion. In most marriages, retirement savings are not evenly distributed. One spouse, typically the one with more continuous employment or access to a better employer plan, holds a significantly larger pre-tax balance. That imbalance creates a specific, predictable tax trap in later retirement. When one spouse dies, the survivor files as single. Tax brackets get cut roughly in half. The IRA does not get cut in half. If most of the pre-tax money lives in one account and that person dies first, the surviving spouse faces the same required minimum distributions, now pushing into brackets that are half as wide. This is not an edge case. It is an extremely common scenario that produces a significant lifetime tax increase for the surviving spouse, and it is entirely preventable. The fix: targeted Roth conversions from the larger traditional IRA while both spouses are alive, using the full width of the married filing jointly brackets before they close. You prepay the tax on the account that will cause the most damage later at the most favorable rate available. The surviving spouse inherits a Roth with no required distributions, no tax on withdrawals, and dramatically reduced IRMAA exposure. The math on this, across a 15 to 20-year retirement, is consistently significant enough that I'm genuinely puzzled it never seems to be the first conversation in any couple's planning meeting. Strategy 6. Inherited IRA compression planning. The Secure Act of 2019 changed one rule that reshaped the math of inheritance planning entirely. Most non-spouse beneficiaries, meaning your adult children, must now completely empty an inherited IRA within 10 years. Not gradually over a lifetime, the way the old rules allowed. 10 years. 10 years sounds like flexibility. It isn't. Those distributions stack directly on top of whatever the beneficiary is already earning. Picture a 44-year-old earning $150,000 per year. She inherits an $800,000 traditional IRA. She distributes roughly $80,000 per year for a decade. That $80,000 stacks on her salary. Combined taxable income, $230,000. Marginal rate on most of those IRA distributions, 32%. Tax paid on an $800,000 inheritance, approximately $256,000. On money her parents saved carefully across 40 years of work. Compare that to a parent who converted $400,000 to a Roth during their own retirement at 22%, paying $88,000 in taxes at conversion. The daughter pays zero on those Roth distributions. The family collectively saves over $160,000 in cumulative taxes. She also has complete flexibility in timing because inherited Roth distributions carry no required schedule and generate no ordinary income. The parent who leaves the traditional IRA unconverted is not being negligent. They are operating on inheritance rules that the Secure Act made obsolete. The 10-year forced distribution requirement is one of the most significant changes to retirement planning in a generation, and most people's estate plans have not been updated to reflect it. Robert has 2 adult children in their 40s, both earning competitive salaries. His $1.4 million traditional IRA, delivered to them under current law, is not a gift. It is a tax liability with their names on it, timed to arrive during their most expensive earning years. His accountant has never projected this scenario. As with the IRMAA surcharge, no system will send a warning in advance. Strategy 7. Tax diversification. You've heard diversify your investments enough times that it is ambient background noise at this point. But tax treatment diversification, building retirement income across 3 distinct tax categories, is equally important, and almost nobody applies the same rigor to it. The 3 buckets are tax-deferred accounts, meaning traditional IRAs and 401ks, taxable brokerage accounts, and tax-free accounts, meaning Roth IRAs and health savings accounts. The goal is not to predict which bucket performs best in the future. Nobody knows what Congress does with tax rates over the next 30 years, and I say that not conspiratorially, but arithmetically, because the federal debt is approaching $36 trillion, and the fiscal math over the next 3 decades is genuinely uncertain. The goal of tax diversification is to make sure no single future tax outcome can eliminate your options entirely. When all your retirement savings sit in tax-deferred accounts, which describes most people who diligently max their employer plan, your financial security is one bet: that tax rates stay roughly where they are. One dial, not yours. But when your savings span all 3 buckets, you choose each year where income comes from based on current conditions. IRMAA threshold approaching. Draw from the Roth. Capital gains rates favorable. Harvest from the taxable account. Bracket has room, convert more to Roth. 3 dials, all yours. Imagine placing your entire retirement income on the assumption that Congress will maintain stable, predictable tax policy for 30 consecutive years. And while you work through that thought experiment, I've heard there is some remarkably undervalued oceanfront property available in Nebraska. Tax concentration risk is the retirement version of holding one stock and calling it a portfolio. The same investors who would never touch a single stock portfolio have 90% of their retirement savings in one tax treatment and sleep completely fine. Tax diversification takes years to build intentionally, which is exactly why acting before you stop working is worth substantially more than acting after you already have. Let me now make all of this concrete with one realistic scenario. Gary is 63. Linda is 61. Gary has $800,000 in a traditional IRA. They have $90,000 in a taxable brokerage account and essentially no Roth savings. Neither has claimed Social Security. They spend about $70,000 per year in retirement. Their income right now comes entirely from the brokerage account dividends and modest planned sales. Their taxable income in year one lands around $35,000. They are inside the 0% capital gains bracket and well below the ceiling of the 22% ordinary income bracket. There is significant room to run a Roth conversion and a capital gains harvest simultaneously in the same year. If Gary converts $60,000 per year from the traditional IRA to a Roth for 7 consecutive years, he moves $420,000 total. He pays approximately 22% on most of it, roughly $93,000 in taxes over those 7 years. Gary and Linda simultaneously harvest and reset cost basis in the taxable account each year at 0%. By age 73, Gary's traditional IRA is substantially smaller. RMDs are lower. IRMAA exposure is minimal. Linda, as the likely surviving spouse, inherits a large Roth with no required distributions and 0 tax on withdrawals. Conservative lifetime tax savings compared to doing nothing, over $250,000. Same accounts, same investments, same risk level, different timing. That is what it means to touch the dial. Step back from all 7 strategies and look at what they share. None require smarter picks. None require predicting markets. Every single one is a decision about when income appears on a tax return and what form it takes when it gets there. You cannot control what markets do. You cannot control what Congress does. But the timing of your own income in retirement is a dial that belongs to you. The question is only whether you pick it up. Robert still has options. He's 68, probably 15 to 20 more years ahead of him. He can still run Roth conversions before his RMDs compound further. He can coordinate withdrawal sources to manage IRMAA going forward. He can restructure what he leaves his children so an inheritance doesn't arrive during their peak earning years as a scheduled tax event. The dial was never locked. It was sitting on the wall untouched while the bill quietly grew. 3 specific takeaways, calibrated to this topic only. First, if you are between 60 and 70 and have not yet claimed Social Security, treat the Roth conversion window as a time-limited asset that is actively expiring. These are statistically among the lowest tax years most people experience in their adult financial lives, and a significant number of retirees move through that window without converting a single dollar. That is the most expensive form of patience in the tax code. Second, find the IRMAA income thresholds for your filing status today and write your projected retirement income next to them. If you don't know whether you're above or below those lines, you are not managing Medicare costs. You are paying whatever the billing system generates. That is the opposite of touching the dial. Third, if you have adult children who will likely be in their peak earning years when you die, model the inherited IRA math now. The Secure Act of 2019 changed the rules permanently, and leaving a large traditional account unconverted is quietly scheduling a 6-figure tax event for people who are about to inherit your discipline. Lazy investing built more fortune than crypto memes. And the tax code has always rewarded the people who actually read it while quietly, efficiently, and without any announcements, billing everyone else at full retail price.